Absolutely. China is very attractive today. We've been judging the U.S. equity market on bond yields and on the equity risk premium. And very frankly, if we were to judge China by the same metrics, we would be looking at a very attractive equity risk premium for investors to dive into relative to where Chinese bonds are trading today, offering half the yield essentially of what U.S. paper would be offering. Now, I think the issue is that although we still are expecting earnings growth for China's onshore and offshore markets, the speed and rapidity of the earnings downward revisions have given a lot of investors pause. And we do think, if we look at the underlying dynamics of the Chinese economy, 4 out of the 5 major drivers of growth are I think, weaker than people expected, whether it's property, infrastructure, manufacturing, or goods sales. It's really only in services that we're seeing still very healthy demand. So we do think that there is an opportunity here for investors to buy China from a value angle, but one has to be selective. And we really think one needs to combine that value framework with an eye to buying companies that have positive earnings growth this year and that perhaps even have positive earnings revisions.
And it is within that space, as you say, services is the only major part of the economy that's really got momentum at the moment, right? So are you looking at consumer companies? Are you playing into the tourism and the traveling revival?
That's certainly part of the story. We like the hotel space, for instance, and some of the travel, as well as consumer names. But as I mentioned, even on the good side, we're not seeing a uniform pickup in demand. And I think one can speculate on a lot of different reasons for this, right? But one hypothesis we have is that perhaps a lot of the expected benefits or tailwinds from the Chinese consumer, that have been forecasts for the long term have to some degree been mitigated by the amount of disposable income that Chinese households have to spend on the property market. And I think that's also why we think it's sensible not to expect a lot of huge additional stimulus by the government to really move the economy and the older part, if you will, of China's economic growth model upwards, given already high leverage levels, across households as well as the government.